Hello and welcome to Forex.Academy, the #1 website for Forex and crypto education and analysis. In today's edition, we will be discussing position sizing. Position sizing is the technical size of a trade or the monetary risk that a trader is going to take in any given trade. Investors use position sizing to help determine how many units of a particular currency they can purchase or sell, which helps them to control the risk and helps maximize returns. Let's face it, some people might be prepared to go into a casino and put all of their available funds on black or red, odds and evens, and just hope for the best. A few lucky punters might win occasionally, however the house always wins in the end. In Forex trading, we are unlike a casino insofar we use fundamental and technical analysis skills in order to try and stack the odds in our favor. We then utilize position sizing in order to maximize our winning potential and also help to mitigate against the risk of losing trades. In other words, if we do suffer a few losses, we will live to fight another day, unlike gamblers who put all their money on one roll of a dice. Therefore, traders must put up an appropriate amount per trade, given their level of experience, the level of volatility in the market, and proportional to their account balance size. This is where most inexperienced traders go wrong. They simply use too much of their capital per trade, and as a result, when they have a couple of losing trades, they blow their accounts. Statistically speaking, over 70% of new retail Forex traders will blow their account in the first 6 months. This, coupled with a lack of understanding of how the Forex market works and lack of understanding regarding leverage and margin requirements, is an account killer for new traders. In order to be a successful Forex trader, they must learn how to apply correct use of capital exposure per trade or position sizing. Three most important issues are: 1. How much capital they wish to assign to each trade. 2. What is the risk associated with each trade? And 3. Are they calculating position size accurately? All of these issues come under effective risk management and are just as important as any other area in Forex trading, such as technical and fundamental analysis. If traders do not understand this, then everything else they know about the market is a waste of time. In Forex trading, every aspect must work together in unison in order for a trader to consistently win trades. When it comes to trading, capital preservation is paramount to survival. Let's look at example A. Determining capital risk per trade, this is typically a percentage of the account balance. The average percentage per trade risk for traders is 2% as seen here. In this example, a trader could experience 10 back-to-back losing trades for $40 and still have 80% of the capital intact. It is extremely advisable that new traders adopt this very important position sizing risk strategy in order to achieve longevity in their trading careers, especially in the early stages. Once a trader has a consistent winning methodology in place, percentage risk per trade can be gradually increased above 2%. Traders are also advised to try and achieve a minimum of 2-to-1 win-to-lose ratio. This would mean that a trader should be looking to make a minimum of $80 per trade win while risking a $40 loss. Let's look at example B, determining trade risk per trade. Is there an accurate assessment of the probability of a positive outcome? Are there enough reasons in place to enter this trade? Decisions must be made to determine precisely where to place a stop loss. Does the chart confirm a realistic possibility of your trade hitting a minimum of the profit based on the 2-to-1 win-to-lose ratio? One area where new traders fall down is the failure to understand that when they trade in the Forex market, they trade on a per pip basis within exchange rate fluctuations. That is to say, that traders' winnings and losses are calculated on the movements of pips. In Forex, trading pips are calculated at 4 places to the right of the decimal point. Therefore, in example C, if we bought one mini lot on the Euro-USD pair at 1.1100, we would need to place our stop loss at 1.1060, which would give us an exposure of $40. In keeping with our 2-to-1 win-loss ratio, we would put our take profit at 1.1180. Let's look at example D, notional trade sizing. In order to understand position sizing, traders need to also understand the notional sizing of trade. In keeping with our earlier Euro-USD trade example, when setting our trade size on our platform, we need to understand about lot sizes. Therefore, when trading currencies, because we are trading on leverage, essentially when we trade on one mini lot, we are effectively trading 10,000 units of the base currency of that particular pair. And so in our example, we would be buying 10,000 units of euros as the base currency is always quoted first and the other counter currency is always quoted second. If you enjoyed the video, please like and subscribe and comment down below if there's anything you'd like us to cover in future, or if you would like to discuss the topics we have covered. Have a great day.